Michael Scott is President and Chief Investment Officer at a registered investment advisory firm and is responsible for the executive duties of running the business. For over 21 years, he's specialized in closed-end funds and business development company and interval fund data, research, as well as investing. And John is with me today. Great to have you here.
It's great to be with you, Jane.
So now the equity market, we've kind of slogged through April. How have closed-end funds been doing in this environment?
Yes, we're only 3 weeks into April, and the S&P 500 is down about 6.6%. But we measure the closed-end fund universe with our all-sector equity index. It's down about 5.5%. But the net asset value, which is actually the manager's return, is only down 4.4%, about a third less volatile than the regular US markets. Not surprising, because the closed-end fund world is more likely to have value stocks, dividend stocks, energy, real estate, not the AI and meme stocks that sometimes get promoted on the market.
That's right. And we have seen energy do pretty well. In fact, it's outpaced tech this year. So yeah.
It's good to be diversified.
That's good, yes. So are there some attractive funds available for investors and advisors to consider in this environment?
It is. At closed-end fund advisors, we always focus on three things: discount analysis, dividend analysis, and kind of manager analysis, or the NAV. And so some funds that are rather attractive and relatively common in our client portfolios are AOD. It's the Aberdeen Dynamic Dividend Fund. It's about a 15% discount. It's about an 8.8 yield. Its beta versus the S&P 500 is like mid-70s. And it's last month's NAV, manager performance, is only down like 3%, so a little sturdier than we've seen in the US. Another interesting fund, a little bit more volatile, but it's the Tortoise EcoFin, TYG. It's an MLP-focused fund, a sector that's actually done quite well this year with everything going on in the Middle East, but its discount's about 18%, and its yield's about 9.5%. But its beta is about 1.09, so definitely more volatile, as you might expect energy stocks to be right now. But it's, 1 month NAV performance is actually up over 1%, the right direction versus we've seen other places. And then in a similar vein, we've got the Nuveen REIT Real Asset Fund. It's JRI. It's about a 14 discount. It's a 10.5 yield. Again, its beta is in the mid 70s, but again, it's down 3% in the last month. And it's, that's half the negative return roughly we've seen for the regular US markets this year.
Right. So now, while these funds have done better when we've seen a down market, what about positions or what you can look for when if they should get more volatile?
So the good thing about closed-end funds is there's like 25 different sectors, hundreds of 423 funds. And so if you are more concerned about the future, you can still get attractive discounts in funds like FLC. It's the Flatley Crumrine Preferred Equity Fund. So preferred equity, it's not common stock. It's almost like credit. It's basically trades on the exchanges, but it's more conservative. Yields about 7%, but it's a tax advantage yield, usually a lot of qualified dividends in these sectors. And it's got a beta versus the S&P 500 right now about 0.4. And the last month, it is down, about 3 and change percent. But still, if you imagine a tougher forward-looking year, a good place to be. In the other vein, another really innovative and useful closed-end fund is the Calamos Long Short Equity Fund. Ticker symbol is CPZ. It's basically an actively managed basket of long and short equity, and then convertibles, which is kind of Calamos's historical focus, and they do light leverage on it. You end up with like a 0.7 beta versus S&P 500, and actually up 1% in the last month. Really, those short positions and the S allocation adding some ballast to investors.
That's true. Yeah, and it kind of protects you on the downside, like a hedge, so to speak. So now there's a smaller number of funds that you typically place in client portfolios. But I mean, what kind of summary data would you give to investors to give them some perspective on?
Absolutely. So we usually have 30 to 40 listed closed-end funds. We'll use a basket of interval funds to lower volatility. We tactically use BDCs or business development companies, which are a wonderful part of the listed universe. But there's only 5 funds, but they're all equity funds. Average 15.5 discount. Really, if you think about the 9.5 average yield, that's almost a little over 2% a quarter of reoccurring cash flow in your portfolio. And we have 2 types of clients: those that really live off of closed-end fund distributions, and those that love to see the cash flow and reinvest it because we're buying back in at discounts where we choose, and a wonderful thing to do in this diversified portfolio. And people sometimes stress out about leverage in closed-end funds. Leverage is scary. It's going to magnify. Closed-end funds are volatile because of leverage. leverage of 23%, I mean, it's way less than a bank, way less than all the mortgage REITs I'm familiar with. It's, I'd say, additive and useful, and really helps you get, for every market dollar in your portfolio, your client's portfolio, if you're a financial advisor, $1.46 of manager assets with this example basket. So you have discounts and leverage really adds the ability for this 9.5 yield. The manager only just have to blend to an average 6.5. So when we talk to investors, not as much today, but 3 years ago, how do you do an 8 or 9 yield? Interest rates are almost zero. Well, because discounts and leverage really magnify the payouts you can get.
Yeah. What kind of advice would you give to investors, or final thoughts about what potentially could be a choppy market? It feels like, we've got a lot of potential things that could happen this year with elections and all of that.
We know each other a couple of years, and I still don't know the future. But I know that a portfolio for an older investor, these funds are on average only 40% exposure to what's even in the S&P 500. While this is a wide discount, it's actually 6.5% wider than the peer group average discounts. At our firm, we call it a comp discount. And then we look at discount ranges, because some funds always trade low, some funds always trade high. This basket's at a 20% 3-year range, and the 3 years we've seen have not been like fluffy and all positive. And so what I'd say is you really got to consider, we have to plan for almost every outcome. Inflation is stickier and trends higher. The federal government cuts rates. Federal Reserve doesn't cut rates. We get a recession. We don't get a recession. The beautiful thing about a portfolio of diversified closed-end funds, you don't have to have only one answer for only one outcome. You put low correlation asset classes, you put the right closed-end fund in the right tax environment, and you're willing to rotate, because these things, on average, in a 3-year period, a basket of closed-end funds moves up and down 15 to 20% around their net asset value. And that's an opportunity to try to take some gains when there's fluff and get in when there's carnage.
Yeah, okay, thanks, John. I mean, always good for somebody to consider this as part of their investment portfolio.
It is, and those that want to go a lot deeper, we do a quarterly 60-minute, 60-deck research call, and you can get to that at cefadvisors.com/quarterly.
Awesome, thank you so much.
Great to be here.
Thanks.